Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I am your co-host, Jared Lee.
And I'm Ben Rose, and this week, a special news episode for October.
Which is our favorite episode every month, I think, as we sort of bring together everything we've talked about, everything that's happened in reinsurance. But this month, October, is Baden-Baden month, and you have just come back. So welcome back to the podcast from Germany.
Thank you very much. I wasn't alone as well. We had 4 superseders there buzzing around the conference, so we've got lots of insights to present to you within the news as we go through that today.
Perfect. I was hearing that you were spending much of your time in Germany speaking in both German and French. So I am humbled you're doing the Reinsurance Podcast today in English with me.
I won't try that on the podcast. Too risky, but it's something I'm working on. Something I'm working on, definitely.
Perfect. So we'll start with Baden-Baden news. The event kicked off with the symposium that was put on by Guy Carpenter, with Laurent Rousseau sort of leading that conversation. But it was about this increasing demand for alternative solutions across the space as cedents wrestle with capacity constraints and other things. What were you sort of seeing and getting from that event in particular?
Yeah, I think the overarching narrative that came out was a need for greater transparency, efficiency, and data to make those transactions possible. I think there've been a level of transactions to date, as you said, the demand is increasing, partly due to the lower availability or more expensive availability of more traditional reinsurance solutions, and so the market wants to look elsewhere and to tap into this bigger pool of capacity. But at the moment, it's not always clear to investors why they should get involved or whether it's going to give them the returns they want. We've had one good year of results, but they'd quite like to see a few more. And we're hearing also Burkhard Kies from Lloyd's made the point that increasingly now other markets, including venture capital, private equity, etc., tapping into the sorts of high net worth investors and funds who might typically be providing capital to the insurance side of the market as well. So we really do have to go out there and compete as an industry for this alternative capital if we want it. And at the moment, perhaps the conclusion was we're not as prepared as we could be.
Yeah, it's super interesting. We spoke previously, and over this, as this market has been hardening, we've been talking about where is that influx of capital that we've been seeing, historically, and I think the broader macroeconomic conditions, as you're alluding to, are sort of highlighting the capital is there. It's just we have to fight for it maybe harder than we did 10, 15, 20 years ago when market conditions began to harden. You saw the immediate inflow of capital. It's not quite that same speed, although it begins to look like it's emerging. Kind of in that same vein, the World Bank just announced that they're going to increase their use of cat bonds from 1 billion to 5 billion. I mean, that's a massive step change from that institution. And I think those types of things might help sort of lure those other investor categories into the market. So that might be interesting to see how that pans out.
My overarching analogy that has formed in my mind after I tried to look at accommodation options for next year is capital is a bit like hotel rooms in Baden-Baden at the moment. The traditional hotels are just fully booked and have waiting lists for years ahead. There are a few apartments coming onto the market, people using Airbnb, etc. But the reliability has come into question a few times, and people aren't always sure whether they can go ahead with those transactions. And then on top of all this, they've just built a brand new hotel outside of town, or just on the edge of town by the spa, 130 rooms, and it opened last week in the middle of Baden-Baden, and it's already fully booked for next year. So even the new capital that's being added to the
Yeah.
market at the moment isn't meeting the levels of demand that we're seeing. So it feels parallel to me.
Yeah. Well, it's a brilliant transition, unplanned, of course, on the podcast, to the comments that were made by Franz Josef Hahn, who's the CEO of Peak Re, talking about this increase in demand for reinsurance across Asia. And in that same way, whilst we're sort of seeing a bit of an influx in capacity beginning to emerge, the demand side is also continuing to climb. So it's not just a little bit of a displacement of the capacity side has sort of shrunk, and therefore we have this imbalance. as we try to bring in that capacity, you're seeing at the same time sort of demand continuing to grow, especially in geographies like Asia.
Yeah, no, completely. And I think that will continue to be the theme as we see inflation continue to drive up insured values and loss costs. We are going to see a missing amount of coverage in the market at the moment with the bits that insurers don't really want to retain and the current cohort of reinsurers aren't super keen to pick up. Lots of the talk from reinsurers has been around we want to return to our natural home of the peak exposures or the extreme events and to not pick up all of these secondary perils. I don't know if you saw, for example, this year we've not had a mega cat, right? There's not been one big event that has made 2023 a memorable loss year, but we have broken all of the records. Aon published something on this recently. Apparently, we've had $32 billion cat events. If that makes sense. Not
Yeah,
$32 billion worth of, but 32 separate events that all cost more than $1 billion in insured losses. So uh, that's setting a very, very powerful demand for coverage that insurers don't necessarily want to hold on to all over the world right now. And I think that's understandable as the world grows
yeah.
ever more richer and more exposed.
Yeah. Well, and I think this ties nicely into the comments that Arthur Klinger was making from Everest, that we're not quite at this new normal, right? And I think we're still trying to wrestle with not only the supply and demand imbalance with capital, but also this claims environment that we're going to sort of forever be in. We've been beginning to understand the increase in severity of traditional large catastrophe events, and the frequency we're beginning to get modeled around how much those happen. But this sort of which was sort of before like just below the threshold, but like a billion and a bit losses, that a few of those would sort of trickle through the industry. But now you're seeing dozens of those. What does that look like when the new normal is 30, 40 billion-dollar events every year, and then add on top of that potentially a mega event? So I think the industry is really trying to come to terms with that. Then we also saw there was the storm in Mexico that sort of was a massive miss by the models. So again, the sort of ultra reliable modeling environment that everyone's built their portfolios around sometimes can miss, which is having a sizable impact.
Yeah, in general, at the moment, I think the reinsurers are having a field day because they can point to so many different reasons to continue pushing rate. The you have the geopolitical situations around the world, which are very sadly worsening. It seems every few months we have something else happen. You have the climate change that people feel isn't really modeled properly. You have persistent inflation and interest rates driving changes there as well. And then on top of that, you have these random events that weren't even in the model, weren't expected to be happening at all, like a Cat 5 hitting that side of Mexico. So, yeah, must be a real challenge to be a cedent or a broker right now, saying, "Oh, come on, this is the new normal. This is the thing we have to get used to." The reinsurers can point to all sorts of sources of uncertainty.
Yeah, no, absolutely. Transitioning away from kind of the market conditions as a whole towards the technology side, there's a few interesting things that came out this month there as well. Um, One of the first ones from EY talking about how Gen AI is expected to significantly affect productivity and change the roles that people have in the industry. And we've talked about this before, but it's the sort of the core function of those of various roles across the industry will begin to evolve, and people have to reimagine it, in many ways reestablish the value position that they hold and what they're providing to clients. So I think they're starting to really articulate what that looks like now.
Yeah, absolutely. And I think we've seen a lot of exciting things happen with AI. I think Cordy wrote an article on this recently. Not yet something that we think you should be trusting the insurance industry's data with just yet, but we're watching it very excitedly and experimenting with it a bit ourselves as well to see where it can go. That said, it's not making losses any cheaper to our earlier conversation. The AI
No.
can do a whole lot of things. We hope that, yeah, insurance's cost of doing business is not gonna get cheaper.
Yeah, well, and I think then it leads into this piece from Allianz talking about this surge we're seeing in ransomware attacks, and as people become more and more reliant on technology, and technology poses this really valuable tool and resource for the industry to do things more effectively. It also is opening up tons of opportunity for sort of malicious actors to come in, and Allianz is sort of waving the flag and sounding the siren for we need to have better tools to detect and respond to these types of things, because right now we're sort of going amazing, we have all this super useful technology to help us do more in our jobs and do better in all these types of things, but at the same time it's not without the risk to organizations and everything else.
Yeah,
So
completely. I
go
think the cyber question continues to linger over the market. And actually going back to the alternative capital question, again, until we have this mega cyber cat, I don't think the sort of alternative capital markets feel confident that they know what they're dealing with as the ultimate Armageddon that they're preparing for. So for now, it's the good times, arguably, with like small increases, arguably in ransomware being not as bad as it could get, uh, but they're paying results in the meantime whilst we wait for absence of that mega cat. So we shall wait and
Yes,
see. We shall wait and see.
indeed. And then the final story to wrap up the news for October, with the tech theme and reinsurance specifically, we'd be remiss to not talk about the move for one of the top five brokers, Lockton, adopting Supercede as they begin to build out their reinsurance technology strategy, and refine their data processing. So super exciting news from us and the team and the Lockton team, Claude and those folks. So that's an amazing update from our side.
Yeah, happy note to end on, I think.
Yeah, absolutely. So that's October. Next, we've got Cirque in a few days in Singapore, which I will be attending, and then we're deep in it with 1/1. So until next time, enjoy the last couple days. Enjoy your Halloweens, and we will see you for the next news roundup at the end of November. Thanks,
Yeah.
everybody.
Thanks, everybody. See you soon.